Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 22nd of June. Markets begin the new week in an oddly optimistic mood despite the confusing twist over the weekend in the US-Iran negotiations. The Strait of Hormuz is stuck in an open, close, open again, close now mode, yet interestingly, investors around the world somehow continue to focus on the possibility of a diplomatic breakthrough rather than the risk of negotiations not going well. So we will talk about that and what else will matter this week in terms of economic data and corporate earnings. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the week starts on a surprisingly positive mood, provided the uncertainty in the US-Iran peace negotiations, which Friday got postponed, remember, likely due to Israel's renewed attack on Lebanon. Iran announced on Saturday that it would close the Strait of Hormuz again, but then highly ranked officials from US and Iran still met in Swiss Bürgenstock to kick off the 60-day negotiation period on Sunday. They said that the talks went well so far. US President, meanwhile, tweeted threats again. And here we are this Monday morning. US crude kicked off the week with a small jump past the $78 per barrel level, but rapidly retraced earlier gains. The US and Japanese yields jumped, however, but the latter didn't necessarily prevent the Nikkei, for example, from advancing to a fresh all-time high level on 1. A broad-based technology appetite that also pushed the Korean Kospi and TAIEX index higher. Then 2, softer Japanese yen, which make the Japanese companies a lot cheaper for foreign investors. Indeed, the dollar yen spiked to nearly 161.70 level this morning. We are now clearly moving above the pain threshold for the Japanese officials. Finance Minister Katayama actually did say that authorities stood ready to take action against excessive currency moves at any time from now on, but we haven't seen any action just yet. The CFTC data, on the other hand, confirms that the market is very crowded with short speculative yen positions today, meaning that if the Japanese intervene, we will see a sharp move downwards in the dollar yen that will clear a part of the short yen positions, but won't change the selling pressure on the yen in the medium run. I mean, even last week's rate hike from the Bank of Japan and the expectation of another rate hike from the Bank of Japan this year was not enough to bring the yen bulls back to the market last week. And on the yields front, the 10 and 30-year JGB yields are sharply up this morning on realization that the US-Iran peace talks may not lead to a concrete agreement, with Israel totally out of control today. But interestingly, the multi-decade high yields in Japan don't necessarily attract big Japanese institutions like insurers and pension funds to the JGB market, as they seem to believe that the Bank of Japan's rate normalization will not be fast enough to contain inflation in Japan, which in return will continue to weigh on the real yields, real return from these government investments, making the Japanese government bonds not as attractive as the nominal yields suggest. Indeed, Japanese insurers were net buyers of government bonds in the month of April this year, and that was for the very first month since last July, since 2025 July, but they turned sellers again in May. The latter somehow tempers the reverse carry worries across the globe, but doesn't necessarily solve other problems such as unreasonable valuations, especially for some technology pockets of the market, and inflating bubble worries. Speaking of that, Nasdaq 100 closed last Thursday 2.5% higher, recovering most of early week losses on technology sell-off, and the week started with strong technology appetite, as I said earlier, but Nasdaq futures are slightly in the negative at the time I'm talking here this morning. Let's see if the market turns green in the coming hours, which is a concrete possibility given the optimism that we see in technology stocks in Asia this morning. Because like LG Electronics, for example, in Korea gained more than 10% on news that some of their executives will visit NVIDIA's headquarters today to talk about a potential cooperation between the two companies in physical AI and robotics, which is NVIDIA's new AI ambitions, mind you. But while the volatility in Korean technology stocks is mind-blowing right now, LG Electronics, for example, rose more than 240% in May, just in the month of May, but lost half of its value in the past 3 weeks, Physical AI is sure a promising area, and Asians are uncontestably ahead of the game when it comes to robots, whether we are talking about Koreans, Japanese, or Chinese. But AI promise come with wild price swings that investors should shoulder to eventually claim potential long-term gains in the sector. And that, to me, is the major challenge for investors today. Now, this week, Micron, which has become one of the hottest AI stocks of the year, is heading to the earnings confessional with expectations running sky high, obviously. Analysts expect the last quarter revenue to hit 33.5 to 34.7 billion US dollars, adjusted EPS near $19 to $20, and gross margins above 80%, all thanks to strong demand for high bandwidth memory used in AI servers and the actual boom cycle that we are in and that some investors consider will last forever. Now, the latest technology wobble sent Micron on a roller coaster ride since end of May with big daily moves, and sometimes we're talking about double-digit percentage of price moves up and down within just one session, like 11% up, 13% down, but the patience paid off so far for Micron investors as Micron closed last week at a fresh all-time high level. One share now costs more than $1,130 versus around $125 per share at around the same time last year. That's a tenfold increase, yes, ladies and gentlemen, on the idea and the thinking that the current boom cycle in memory chips will last forever. But it may not, as new technologies, new and more efficient technologies could slow down demand for memories and force investors to scale back future revenue expectations. So the real test will not be the quarterly results from Micron themselves, but whether Micron can convince investors that the AI memory boom still has room to run and whether this boom cycle will last forever. I'm telling you, at the current valuation, anything less than a blockbuster forecast will disappoint a market that has become used to perfection and that has simply went ahead of itself. On the data front, the last week of June will be marked by the US final first quarter GDP and May inflation numbers, with the Federal Reserve's favorite gauge of inflation, the PCE data, due Thursday. Last week, remember, the new Fed chair, Kevin Warsh, chose to put the emphasis on price stability, and the quarterly dot plot also showed that the Federal Reserve members collectively turned more hawkish on their monetary policy outlook for this year, with many, remember, favoring at least one interest rate hike this year, and some seeing an increased need for 2 interest rate hikes in the US in the second half of this year. Therefore, stronger than expected inflation numbers this week could further back the hawkish Fed expectations, push the US yields and the US dollar higher, and potentially weigh on equity appetite. In the FX, the US dollar index rose to the highest levels in more than a year following last week's hawkish Federal Reserve announcement, but the hawkish Fed expectations have already been broadly priced in at this point in time. So moving forward, the stronger US dollar will keep the inflation worries outside the US anchor despite falling oil prices if oil prices continue to fall, and the latter could throw a floor under the euro dollar, for example, within the 113.15 to 114 range due to possibly more hawkish ECB expectations, not on rising oil prices this time, but rather on a more expensive US dollar. For cable, struggling near a critical Fibonacci support today, a further downside becomes increasingly plausible with rising political uncertainty in the UK and unclear spending plans for Mr. Burnham, who is coming for Mr. Starmer C today. Remember, the UK's borrowing costs are very high right now for promising further spending to the Brits, but a political campaign without that promise of more spending and more help for the population would hardly be successful. So time will tell how things will evolve in the UK, but the UK's downward spiral will be hard to reverse without a significant improvement in growth and productivity. And I don't see that happen overnight. If you do, please shout out to me in the comments below. So this is all for this Monday. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.